The higher the rates, the harder the crash. At least that's the case that I'm going to be making in this video, which means I need to answer the question, why would a rising interest rate environment be dangerous for stocks? Specifically, the stock market today. After all, markets are efficient, right? All information and knowledge that is public and has anything to do with the valuation of markets should be priced in already. Information like inflation staying stubbornly high, causing the Fed to say it's going to have to keep rates higher for longer. Or how about the fiscal death spiral the United States government is courting right now, borrowing more and more at higher and higher rates with an exploding deficit? Or how about the balance sheets of consumer discretionary companies in the S&P 500 that are getting worse and worse with higher and higher amounts of leverage? Or how about the fact that 55% of workers say that even though they got a raise, it wasn't even enough to match inflation? This is all public information, so the markets should be accounting for all of that. Well, I'm going to show you why that's not the case. If you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where I teach active investors how to protect their assets from losses while making more money investing in the process. And if you'd like to learn how to mitigate the risk of large drawdowns in your portfolio, sign up for $99 in the description below. And if you'd like to learn how to mitigate the risk of large drawdowns in your portfolio, it's only $99. Sign up with the link below. All right, so number one, we have to look at valuations of the stock market in light of rising interest rates. During the course of 2022, we saw yields on short-term government debt skyrocket. During that time, we also saw a rise in long-term government debt, but percentage-wise, it was nothing like short-term debt. But now over the course of the end of 2023, short-term rates have stayed relatively stable, while the long end of the curve has experienced a massive spike. Throughout this entire time period, the stock market has experienced volatility, yet ever since the end of 2020, it has stayed within the same range. The fact of the matter is that there's usually a relationship between interest rates and valuations. When interest rates go up, valuations are pushed down. Recently, the valuation of the standard 60/40 portfolio hit a 130-year high and has since corrected, but has only corrected down to the same levels it was at prior to massive market crashes in the past. If you want to know why this relationship exists, all you have to do is be able to answer the question, how much would you pay for a money printer? Imagine in front of you, you have an actual printer that prints actual money. This money printer prints out $1 every year. How much would you pay for that money printer? If you answer $10, then that's you saying that you are willing to get a 10% return and nothing less on your money. Now, in this current environment, given the valuations of stocks and interest rates on bonds, that would indicate that you believe that printer has a high likelihood of breaking. Meaning, yes, it has printed out $1 every year for the past few years, but you don't think that it's going to continue doing that for long into the future. On the other hand, if this printer has been around for decades and it consistently prints out $1 every single year, maybe you're willing to pay $20 for it, which would give you a 5% return. Or maybe you even have a crystal ball and you can see this thing will print out $1 every year for the next 100 years, and you are positive about it. Maybe you're even willing to spend $50 on this printer, which would be a 2% return. Now, this is the relationship between the price of a bond and the interest rate that it pays. The higher you're willing to pay for a fixed income stream means the percentage that you're getting is lower. These days, to buy a money printer that is guaranteed by the US government for 2 years, you'll get paid 5%, which means you get $1 for every $20. Interestingly, this is also the exact same interest rate to give your money to the government for 20 years. Now take this exact same concept and apply it to stocks, because the stock market is ultimately just made up of companies that earn revenues and profits and have expenses and have an obligation to pass back those profits to shareholders. Now this can happen through a number of different methods. You can pass back profits through share buybacks, because all else being equal, if the company takes its profits and uses that to buy up shares, that will reduce the number of shares available. It will be buying pressure. It will, all else being equal, push up the price of those shares and allow shareholders an exit at a higher price, returning that value to shareholders. Those profits could also be retained. They could be kept for a cash buffer. They could be reinvested in the company, and they could also be paid out to shareholders as dividends. But the question still remains, how much are you willing to pay for a money printer? Because at the end of the day, that's what a company is. This number is typically measured with the PE ratio, the price compared to the earnings. And you can see at about 24, the S&P 500 is at a level that up until the late 90s was really never breached. This means that the price of stocks in the S&P 500 are still priced at a point that they were back when interest rates were much lower. So when you're comparing two money printers, let's say government bonds versus the S&P 500, the more the government bonds pay, the less attractive the S&P 500 becomes. The S&P 500 as a money printer becomes more attractive only if you can get it at a lower price, thereby paying less for those same earnings. And that's not to say that every dollar that is invested in the S&P 500 would look at bonds and say, hey, that's more attractive, but maybe just a few. Maybe it's a little bit of a repositioning, a rebalancing of the portfolio to allocate more to the more attractive money printer and less to the less attractive money printer. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. And they're straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. I might think, but wait, what if the money printers are paying the same? Well, in that case, there's actually even more of an incentive to shift from equity to credit. And this is because from a worst case scenario standpoint, bonds are superior. Imagine you decide to open up a small business. You take on debt for the company to get started. You operate for a couple of years and it's just not going anywhere. So you decide you're going to have to close down the business. When you close down the business and you liquidate all the business assets, you're left over with, let's say, 100 grand. But before you can take that 100 grand and put it in your pocket, you still have debt that you have to pay off. So let's say there's 90 grand worth of debt you pay off. You now have $10,000 left over that you can put in your own pocket. There is no distribution after a business failure to the owners until the debt is paid off. And that's the exact same way it works in public markets as well. Should a large corporation that's a part of the S&P 500 or any other index fail, first, everything is liquidated and you take that money to pay back the bondholders, the creditors, first, and anything left over can then go to the owners, the shareholders. And so the higher interest rates go means that number one, not only are bonds in a worst case scenario considered the less risky option because they get paid out first should something catastrophic happen, but the higher rates go, they actually may start presenting a better option for profit, for income, for the upside potential, given the fact that valuations are still so high, historically speaking. Also take into account that Bank of America recently put together a 5,000-year study that goes all the way back to 3000 BC, showing that within the last couple of years, interest rates were at a 5,000-year low, and we are now coming off of that low back up to much more normal levels, meaning that given the length of history going on here, I wouldn't bet against rates staying higher. Now, it's true that markets are a future discounting machine, meaning that if all market participants had a crystal ball and we could all see that Amazon was going to be worth $500 a share tomorrow, immediately everybody today would start to buy until it got up to $500 per share today. So the more certain a future outcome is, the more that will be reflected in today's price. The less certain a future outcome is, the less that will be reflected in today's price. This means that the current valuation of the stock market would indicate that the consensus doesn't believe valuations are too high. at this point. I think the biggest reason why this is the case is because of active investors versus passive investors. Passive investing is overtaking active investing. And for equity funds in the US, this already happened in 2021. For those unfamiliar, a passive investor is somebody who blindly throws money into the stock market, into as many different stock market indexes as possible, and says, hey, if I just spread my money out as wide as possible, then I'm guaranteed to win. Ignoring the fact that literally everybody else is doing this exact same strategy, which means that when everybody else has to sell, they're selling the exact same things that you're selling. On the other hand, active investors look to find value. So they try and buy things that look undervalued and try and sell things that look overvalued. Now, passive investing works great when active investing is the dominant form of investing in the market, because all active investors will compete against each other, forming real valuation being priced into the markets, and the consensus will be broadly right. Therefore, passive investors can ride on that wave and take a free ride. But when passive investing overtakes active investing, you get a very dangerous setup in the markets where everybody is buying simply because money is going in, regardless of what the value looks like. Dangerous because when that flips to selling and everybody has to sell for one reason or another, everything gets sold regardless of what value looks like. This is a massive potential opportunity for active investors to be able to take a look at things that are overvalued and bet on the market eventually correcting that, and wait for those things to be extremely undervalued, because there's a very good chance we start to see very attractive valuations, especially in certain asset classes, very soon. But the fact that passive investors have overtaken such a large share of the market means that very few people care about valuations anymore, which means that a large percentage of the money being invested buying these money printers doesn't actually care how much the printers cost or how much money those money printers print. The next reason why a rising interest rate environment is dangerous for an overvalued stock market is because of crowding out. Investors can loan their dollars to the United States government for 6 months and get over 5.5% on their money. This is backed up by the full faith and credit of the United States government, which really means the monopoly on violence. If push comes to shove, they can always get back the dollars they need to pay back the lenders. Corporations, on the other hand, cannot do this. When was the last time you heard of Apple putting people in jail for not buying iPhones, or Amazon putting people in jail for not signing up for Prime? So when you can get a risk-free return and that return continues to increase because of the unrelenting, unending demand for borrowing by an entity with a monopoly on violence, it crowds out investing in productive private enterprises. They simply can't compete with that. And then finally, the reason why this is dangerous for an overvalued stock market is because it puts upward pressure on debt service costs for all those corporations. We know that many companies in the S&P 500 are extremely overleveraged and getting worse every year. But just as before, if I can loan my money to the government for 5 or 5.5%, if I'm going to loan my money to a corporation, I'm going to need at least a little bit more than that. So the fact that the government is extremely overleveraged and borrowing to fund those ballooning deficits is just making it more and more expensive for corporations to service their debt. This can contribute to higher prices because those corporations will then have to charge more for their products and services just to maintain solvency. This is one of the ways in which a ballooning deficit can contribute to inflation even without money printing. It's not always about the money printer. This is evidenced by the fact that the growth rate of the money supply has actually been negative ever since the end of 2022, which means the money supply is actually shrinking right now. They're not printing money right now. They're doing the opposite. In conclusion, a rising interest rate environment is bearish for stocks, especially a stock market like today, where nobody's paying attention to the ultra high, historically speaking, valuations. We've got a long way down to correct for this. And if you're an active investor and you'd like to learn how to position your portfolio not only to be able to protect yourself from losses during this revaluation downwards, but also profit off of it, that's what Heresy Financial University is for. Sign up with the link in the description below. As always, thanks so much for watching. Have a great day.